All right, let's start with a question that sounds simple, but really isn't. Where does money actually come from? Now you're probably thinking, well, the government, right? The mint prints it. But what if I told you the real answer is much closer to home? In fact, it's a secret that's hiding in plain sight, right inside your bank. Let's get into it.
So let's kick things off with a little puzzle. Picture this. You go to your bank and deposit $1,000. A little later, the bank lends out $900 to somebody else. But here's the weird part. When you check your account, your $1,000 is still sitting there. So, where on earth did that extra $900 for the loan come from? The answer? Well, it's going to change everything you thought you knew about banking.
Okay, to get to the bottom of where that new money came from, we first have to bust a huge myth. It's the story we've all been told since we were kids, the idea of the bank as just a big, safe money warehouse. You know the drill, right? You put your money in, the bank sticks it in a vault, and then it acts like a simple middleman, lending out a little piece of your cash to someone who needs a loan. It makes perfect sense. It's nice and simple, and it's almost totally wrong.
Now, to be fair, this story isn't just made up out of thin air. It actually has some pretty deep historical roots. It all goes back to medieval goldsmiths. See, they figured out pretty quickly that they could hand out more paper receipts for gold than the actual gold they were holding in their vaults. And boom, that was basically the birth of fractional reserve banking. And that's exactly why the whole warehouse story is so believable. The big problem, though? The system has changed dramatically since then, but the story we tell ourselves hasn't kept up.
Okay, so now let's start poking some holes in that old story, because once you start looking closely, the whole thing starts to unravel, and fast.
All right, here's the first big crack in the myth. When the bank made that $900 loan, the total amount of money in the economy actually went up. Think about it. Your $1,000 didn't shrink, but suddenly this borrower has $900 new dollars they didn't have before. The entire economic pie literally got bigger. Now, how is that possible if the bank is just a warehouse moving existing money around? It shouldn't be.
And that brings us to this classic chicken and egg problem, right? The old textbook story says you need deposits first to make loans. But when a bank makes a loan, that new money gets spent. And where does it end up? As a new deposit in someone else's bank account. So, which is it? Do deposits create loans, or do loans create deposits? That one question right there totally blows up the old warehouse model.
So okay, it's time for the big reveal. Let's go ahead and rip that old page out of the textbook and look at how money is actually created in our modern economy.
And look, don't just take my word for it. This comes straight from the horse's mouth, the Bank of England itself. This isn't some fringe conspiracy theory. It's a cold, hard fact confirmed by central bankers around the world. Here it is. Commercial banks create money in the form of bank deposits by making new loans.
So let's just lay it all out, side by side. The myth? Banks are just intermediaries lending out money that already exists. But the reality? Banks are actually money creators. They don't lend out your deposit. When they give someone a loan, they create a brand new deposit for that person, literally out of thin air.
And how do they do this? It's all done with a few keystrokes on a computer. Seriously, when a bank approves a loan, two things happen on its balance sheet at the exact same time. It creates a new asset for itself, that's the loan, which you have to pay back. And it creates a new liability, that's the brand new digital money it just typed into the borrower's account. No stacks of cash are moved from a vault. It's just created.
But wait, I know what you're thinking. What about reserves? Aren't banks required to hold on to some of the money? And yes, you're right, they have reserves. But here's the crucial detail. Reserves are a special kind of money that banks only use to settle payments with each other. Let's be super clear about this. It's not customer money, and it is never, ever lent out to you or me.
And if that wasn't mind-blowing enough, get this. Since March of 2020, the official reserve requirement for banks in the US has been set to 0%. That's right. The amount of money they're legally required to hold in reserve against your deposits is, well, nothing.
Okay, so if banks can literally create money out of thin air, and they don't even have to hold reserves anymore, what in the world stops them from just creating an infinite amount of it? Why aren't we all billionaires?
Well, thankfully, it's not a complete free-for-all. There are some very real, very powerful brakes on the system that keep things from going completely off the rails. Banks are limited by a few key things. They have to make profitable loans, they need to have enough liquid cash to handle withdrawals, but the biggest one, the most important limit, is something called capital requirement.
So what are capital requirements? Basically, regulators force banks to fund a chunk of their lending with their own money. We're talking about money from owners and shareholders. They have to have their own skin in the game. And why? So that when some of their loans inevitably go bad, the bank can absorb those losses without going under. It makes sure that the bank's owners feel the pain of bad decisions, not just the depositors.
So what we have here is this incredible, powerful engine for creating credit and fueling the economy. But like any high-performance engine, it's also really, really fragile. What happens when it starts to sputter? You see, this system is really a double-edged sword. On one hand, it's the engine of growth. This ability to create credit on demand is what allows businesses to expand and hire, and it's what lets people buy homes. It's the fuel for our entire economy. But there's another side. That exact same power is what can lead to out-of-control inflation, massive asset bubbles, and, you guessed it, devastating economic busts when all that credit suddenly vanishes.
The system's Achilles heel, its greatest weakness, is that the whole thing runs on one simple ingredient: trust. Because banks create way more digital money than they have in actual physical cash, the entire structure is vulnerable. If enough people lose trust and demand their money all at once, the bank collapses. That's a bank run. We saw it in the Great Depression, and we saw it happen again just recently in 2023 with Silicon Valley Bank.
And that inherent fragility, that's the exact reason we have safety nets built into the system. You've heard of the FDIC, right? That's the government insurance that protects your deposits, up to a certain amount. And the Federal Reserve can step in as the lender of last resort to give emergency cash to banks. These things don't exist just for fun. They're here because everyone knows the underlying system is both incredibly powerful and incredibly delicate.
So when you boil it all down, here's the big takeaway. Our entire modern economy is built on a system where commercial banks create money as debt. It's a system that's given us amazing growth, for sure, but it also seems to need to grow constantly, forever, just to keep from collapsing. And that leaves us with one final and maybe unsettling question to chew on. What happens when it can't grow anymore?